Yes. On the key macroeconomic concerns, we said that we have got the economic growth as the first one. Economic growth, that is followed by unemployment, followed by inflation, of which inflation is followed by the balance of payments. We said these are the key macroeconomic concerns, and they are there to summarize the entire course of macroeconomics. Are you able to see the screen that I'm sharing, and am I audible enough?
Yes, you are. Thank you.
Okay. So now let's zero in now and pick economic growth. I said what we look at under economic growth, we are interested in knowing, okay, we are interested in knowing whether the economy of the country is growing or is not actually growing. So the question is the economy of the country growing, or it is not, it's not actually growing, it's just static, or maybe the growth, it is declining, you know? Those are the questions that we answer. And for us to establish that, we say that we need what is known as what are known as the key indicators, right? We need the indicators. The indicators must be there to help us determining if the economy, or giving us the direction that the economy is heading. Is it slinking, or it is actually increasing? Is it growing, or it is actually declining? Very, very important. And on those key indicators that I talked about last time, I said the first one is what is known as the gross domestic product, a GDP. So we have the gross domestic product, GDP, as the first one. It is one of the indicators actually that we use to measure. Okay. You are able to see the screen, right? Are we able to see the screen?
Yes, sir.
Okay, thank you. So we have the gross domestic product, GDP. Now, by definition, GDP is a measure of the income and expenditures of an economy. Okay, that's the basic definition. To be more specific, you can define gross domestic product, GDP, as the total market value of all the final goods and services produced within a country in a given period of time, usually a year. I repeat, by definition, GDP is the total market value of all final goods and services produced within a country in a given period of what? Period of time. So the keywords here that we have in the definition are the total market value. It is the market value that we look at. The market value, and actually it is the final one. Okay. It is measuring the final goods that have been produced, not the intermediate goods. Okay. So the value of the goods that we are looking at are final goods. And usually the period of time is not open-ended. It is usually for a given period of time. Most of the times it is a year. Okay. So that is what GDP is all about. I can actually add to the definition of GDP that it is actually this production that has been done within the country boundary, okay? It is within a country. That is a key word as well. Very important. You need to underline these words because they will help us to answer some questions in the long run. Within a country boundary. So we are trying just to measure the level of production of the goods and the services, okay, within our country boundaries, that is regardless of the people who own the factors of production. You didn't get that one, I'm repeating. We are concentrating on the production that has occurred within our country boundaries, okay? On the production that has occurred within the what? The country boundaries for a specific period of what? Of time. And this is regardless of who owns the factors of production. Bringing it home, we are just concentrating on the production that has occurred within Zambia. We are not caring who owns those factors of production or the inputs. So whether the people who own the factors of production are outside, are foreigners, they're Chinese, they're Americans, they're Rwandese, they're whatsoever, wherever they are coming from, they're Congolese. You see, we don't care about where they are coming from. They can come here, set up their companies, they start producing, set up factors of production, buy land, get capital, enterprise within the country. As long as the production takes place within the country, that is captured within the GDP. That is very important to underline. It is captured within the country boundary. We don't care who owns, whether it is a national. By national, we mean the person who is a resident of the given country or a citizen. Whether it's our citizen that have produced or not, we don't care about that. What we just care about is the location. Has the production taken place within the country boundaries? I've taken time to explain this because it's a key factor that will save you where you're going. So pay attention to that. Is that clear? Hello?
Yes, it is.
Okay. How do we measure GDP? Output is valued at market prices. This is what I've said. At market prices, actually, it does record only the value of final goods, not intermediate goods. The value is counted only once. We do not count the intermediate goods. This does include both tangible goods and the intangible ones. So that is the services, okay? So GDP captures both the tangible goods and the intangible services. That would include haircuts, house cleaning, the services that are offered within the country, including those that we can manage. Now, on the part of the intermediate goods, maybe you may be wondering what is meant by the intermediate goods. So the intermediate goods are basically those goods that are still going to be used for further production. They are not the final goods, okay? Those goods that are going to serve as raw materials for further production. They will still be used as inputs for another stage of production, right? For example, of what you may call intermediate goods. Let me give you this hypothetical example. You have a miller, not a miller. You have a farmer. Check this farmer. This farmer is producing wheat. He produces wheat and values the wheat at 1,000. Okay, let's say 1,000. No, that's too much. Let's make it 100 so that we are not confused. 100. This is wheat been produced by the farmer. Follow nicely. The farmer sells the wheat to the miller. Okay. So the miller works on the wheat and makes it flour. Okay. So there is this flour, and then he sells the flour at 300. Then the flour has been sold at 300. Okay, to who? To the baker. Okay. We have the baker here. The baker has converted the flour into the bread. Okay. From the miller, you have got the baker. The baker has converted the flour into the bread and has sold the bread at 600. Okay. So let's see what is happening. I want you to understand the meaning of intermediate goods. There is a farmer here who is starting the production, the process. I repeat, he produces flour, wheat. Wheat is sold to the miller who converts it into flour. Flour sold to the baker who makes bread and sells it at 600. So what we mean by intermediate goods, we mean things like flour. Okay? When you look at flour, flour is not a finished good. Okay? Because this flour in this context shall still be used to make bread. Okay? This flour is going to be used to make what? To make bread. Bread shall be the final good because people are going to consume the bread. Right? People are consuming the bread. They're not going to use the bread for further production. They are to make produce something else. Mainly, this bread, by this assumption, we say is going to be consumed. So the bread shall stand as the final product, final good, and flour shall be an intermediate good. Are we good? Do I have any question? Is there any question here? Okay. We can proceed. Are you able to hear me before I can continue talking? Am I audible to the class?
Yes, you are.
Okay, thank you. What is counted in GDP? We said gross domestic product GDP includes all items that are produced in the economy and are sold legally in markets. Follow nicely. These are some of the keywords. All items that are produced in the economy and are sold legally, underline the word legally. They are sold legally in the market. So this simply means some things are not counted in the GDP. Okay. And what is it that is not included in the GDP? Number one, most of the items that are produced and consumed at home that never enter the marketplace are not counted within the GDP. For example, you may be aware that your wife may be a good cook, or whoever is cooking for us home may be a good cook. And as they are cooking, their services actually deserve payments. Okay? Deserve payment. If they are just maybe working for a certain, I would say, maybe restaurant or something, they would have been getting paid for those services. But since they are working home, they're even cooking very good food, but that food is not priced. And so those services don't even go on the market. They're not captured by GDP. Right. So as long as those services or those goods, the production that takes place within, it takes place from home. So it does not go on the market to be captured. So it will not be captured by GDP. GDP does not include the items that are produced and sold illicitly, such as illegal drugs, human trafficking, among others. Okay. Those items that are produced and sold illegally, illicitly, they are not included in the GDP. because the sale of those may not be captured, may not go on the market. You may not be able to find people selling cannabis, selling cocaine, those drugs that are prohibited right on the market. And because of the same, those items are not captured by GDP. Are we together? Do I have any questions so far? Are you able to hear me? Maybe opening to the class. May the class suggest some of the other things that they think are not included in GDP. I've said number one, intermediate goods. Those things that are not added in, what's the production that takes place home? Things sold illegally. What does the class think may not be captured within GDP? Hello? Is there any idea from the class of the other things that may not be captured by the gross domestic product, GDP? Okay. Hello, but we are together. Are you able to hear me? Hello, is the class able to follow? Okay. Can I just get the feedback if you're able to hear
Yes,
me?
I can hear you from my hand. I can hear you from my hand. I don't know about the others.
Okay. All right. Thank you for the feedback. The other measures of income. We have talked about GDP as the main measure of income. Now let's talk about other measures of income. Number one, gross national product. You should pay attention to these. We will need them when we start calculating. And actually, your calculations may be correct, will only be correct if you understand this part. Otherwise, if you don't get this one, you have troubles when you start calculating very soon. Macroeconomics is highly quantitative. We are dealing with a lot of calculations. So you have to pay attention. Understand this that I'm delivering right now. Gross national product, GNP. Now, I have talked about gross domestic product, GDP, right? I have talked about GDP. Now I am talking about GNP, which is gross national product. There is net national product, NNP, and national income, personal income, and disposable income. I'll talk about these and show you what they are. Let us start with the gross national product, GNP. What is GNP? It is given as the total income earned by a nation's permanent residents, the nationals. The income that is earned by the residents of the nation, the permanent residents. We call them the nationals. How different is it from the GDP? These are the points that you need to get now. How different is GNP from GDP? Okay. It is different by including income that our citizens earn abroad, and it does exclude income that foreigners earn here. I'll repeat. It includes the income that our citizens earn abroad and excludes what foreigners earn here. That's GNP. I'll repeat this point so that you get it properly. What GDP does, if you have got people who are here, they are owning companies within Zambia, for example, within your country, and as they own the factors of production, pay attention. You have got people who are not citizens, they own factors of production and they are producing within the country. We say that under GDP, whatever production takes place within the country boundary is captured by GDP. But when it comes to GNP, GNP just concentrates on what our citizens have produced, regardless of the country boundaries. I'll repeat, regardless of where, okay, the factors of production are located. As long as the people that own the factors of production that have been involved in production are our nationals or are our citizens, that is captured in the gross national product, GNP. So in other words, we are saying there is that time when we have our citizens who are Zambians that they own factors of production, they have companies, they have investments, they have land outside the country. Okay? In GNP, even if those things are outside the country, they are captured by GNP because they are owned by our citizens. Those things may be within the country or they may be outside the country. So we just capture, in short here, under GNP, we just capture what our citizens owns or what we own. That is what is captured by GNP. Regardless of where we own it from, whether we own it from within the country or outside, that is captured by GNP. But under GDP, I told you, we don't care who owns the factor of production. We just care that the production has taken place within the country boundaries. That's under GDP. So if GNP, please, we concentrate on what we own. Is that clear? Have people understood what GNP is and how different it is from GDP? Have we gotten that indicator? So some situational question may come, okay? May come. Someone asks you true or false that if you have investments from outside the country, let's say you have investments in the UK, those investments are captured in GDP. Is that true or false? I just want the class to exercise here now. Test your understanding. We have investment, we have land in UK, or we have buildings there. There are people paying rentals in the UK. Is that captured in GDP? How true is that? Is that true or false? Is it true that it is captured by GDP?
False.
It is false, right? We said that what is captured by GDP is what we own within the country boundaries. As long as it's outside, that is captured by GNP. So you have to pay attention to this. Okay. So I have talked about this for a long time. We have understood. Net national product is another indicator. Okay. Net national product, NNP. Now, what is it? NNP is the total income of the national residents, the nationals, less depreciation. The total income of nationals, we know that it is called GNP, right? So in other words, how do you find NNP? Net national product is found by saying GNP minus what? depreciation. Even the formula has been constructed now. This is an equation. These equations, you need to get them. They will be very useful as we start calculations. Get them so that you're not mixed up. I'm saying net national product. It is given by GNP, gross national product, less depreciation. Right? So that is to say, in the time when they give you the net national product, they also give you depreciation. Then they ask you to calculate for what? For GNP, gross national product. Our GNP shall equal net national product NNP plus depreciation. Is that clear? See how we are manipulating the equation? So just get depreciation, cross the equal sign to the other side of the equation. You will have GNP. This conversation is serving as a very strong backbone to the quantification that we'll do under national income accounting. Please pay attention. GNP is given as net national product plus depreciation. Okay? Plus depreciation. Once we less depreciation from GNP, we will have the net national product. Is that clear? Okay.
Yes, sir.
The other name for depreciation shall be consumption on fixed assets. Consumption on non-current assets or fixed assets. Please, when you are reading, pay attention. Sometimes you may find the writing consumption and it also have consumption on non-current assets. Get it from here that the consumption on non-current assets or the consumption on fixed assets is also called depreciation. It's actually the other name for depreciation. I repeat, the other name for depreciation is consumption on non-current assets. Very important. So that in case you find consumption on non-current assets, you don't start worrying. Depreciation is the wear and the tear on the economy stock of equipment and structures. It is the wear and tear on the non-current assets. Obviously, most of you already have the background from accounting. You understand what depreciation is and even understand it better. The other indicator of economic growth is national income. Now, what is national income? What is national income? National income is the total income that is earned by our nation's residents in the production of goods and services. It is different from net national product by excluding indirect business taxes, and it does include subsidies. I'll repeat. So to find national income, you subtract from net national product indirect taxes and you include the subsidies. Okay. So national income shall equal net national product less what? Indirect taxes. Indirect business taxes plus what? Subsidies. Is that clear? Now, you should understand these equations, and I actually encourage you to write somewhere. Because we will be playing with these equations and manipulating them to answer a lot of questions in national income accounting. So, how do you find national income? from net national product. And obvious, you know net national product, right? That net national product is coming from GNP. When you subtract depreciation from GNP, you have net national product. When you less indirect taxes from net national product and add subsidies, you have national income. What do you even understand by subsidies? A question to the class. What does the class understand by subsidies? Would you explain that by giving practical example? It could be Zambian example. What are subsidies? What do you understand by subsidies or subsidizing? Hello? What does our good class understand by
subsidy? Could be an incentive that.
Go ahead.
Yeah, so it's a form of incentive that the state, for example, may give the company just to cushion maybe the cost of production of a particular good. Yeah, it's an incentive.
Okay, thank you very much. Would you be able to couple the explanation with a practical example?
Yeah, so for example, when it comes, maybe there's a cost of, well, the price of mealie meal has gone up, for example. So instead of the millers footing the entire cost of producing that mealie meal, say maybe government can give maybe, for example, maybe a reduced maybe tariff in terms of electricity, if that's where maybe the cost is coming from, it will be at government cost, or maybe transportation of maize from one point to another just to cut off the cost in terms of production of maize. So something of that nature.
Okay, thank you very much for that one. Thank you. Yeah, that's very much clear. So the government has seen that a certain product is very important to the citizens, but the cost of production thereof is high. And so the government has to help. How does the government help the citizens or protect the citizens? It is indeed imperative for the government to cut the cost of production by helping the producers, helping the firms involved in the production processes. So they look at what is it that is really hiking the prices or that is increasing the cost. Could it be electricity? Could it be the raw material for mealie meal, for example, maize? Is it that maize is becoming expensive? So you will see the government will try by all the means, maybe provide maize, or maybe they will do whatever they can. They will add, they'll cut, they help the company on the production process by reducing the cost of production. Sometimes they can even remove taxes. They can remove taxation on the production of that product just to ensure that the production can continue. Those are called subsidies. Thank you very much. Now the class understands what subsidies are, and you understand what it means to subsidize. So once you less indirect taxes and add subsidies to net national product, you will have national income. Thank you. Okay, these are the indicators of economic growth. Very important. Let's have personal income now. What is personal income? Personal income is the income that households and non-corporate businesses receive. It is the income that households and non-corporate businesses receive. How different is it from national income now? It is different in that it excludes retained earnings, which is actually income that corporations have earned but have not paid out to their owners. That is what retained earnings are. You are from accounting background, you understand retained earnings, that It is the income from when the business has been operating, has made profit, right? Then not all that profit is given out to the owners. Some of it is kept into the business. That is what we call retained earnings. So the retained earnings are not added to the national income accounting. So it is from national income minus retained earnings, then plus the interest income and government transfers gives us personal income. I'll repeat. Personal income, it is given by national income minus retained earnings plus interest income plus government transfers. I'll write down so that you follow nicely. Personal income. What is personal income? It is national income minus retained earnings plus interest income plus what? Plus the government transfers, plus the transfers. These make personal income. So from the personal income, to get the personal income, you less retain the earnings from national income, then you add the interest income and the government transfers, then you have personal income. All right. Now, what is disposable national income? These are the key indicators of measures of economic growth, right? I talked about GDP, GNP, net national product, national income, personal income, disposable personal income. This is the last one I need to indicate, comment on already. What is disposable income? Disposable personal income. It is the income that households and non-corporate businesses have left. That is after satisfying all their obligations to the government. It equals personal income minus personal taxes and certain non-tax payments. So what happens is that from the personal income that you have, from the personal income that you have, you less, okay? So it is personal income less what? Less taxes and less any payments, okay? The non-tax payments. Then you have what is known as disposable income, okay? That will give you disposable income. I repeat, personal income, and you have known what personal income is, I just gave the equation previously. So from personal income, once you less taxes, you less payments, and then you will have what is called the disposable income. Very, very important to understand this. So now we have, in a nutshell, brought to light the key measures of economic growth. These are they. So next time what we do, we zero in, we look at them one by one. We'll start from GDP now, the components of GDP and what makes up GDP. That's what we are going to talk about. Let me now call for questions.